Hey traders, welcome back to uGenesys, and today I want to introduce you to our psychological levels indicator, also known as the round levels indicator. So, psychological levels are price points in financial markets that hold significant meaning for traders and investors, mainly due to their simplicity and ease of remembrance. Typically, these levels are round numbers, ending in 00 or halfway points like 50. So here on this Euro USD chart, we can see these levels at 1.08500, 1.09000, 1.09500, and 1.10000. These are the areas that the price loves to visit. Now, even though this is a Forex theory, it certainly holds up when trading. Not only is price attracted to these levels, but these levels also act as a dynamic support and resistance. Now, our indicator finds the most reactive psychological round levels, meaning that the best levels where we think that price will reverse from. So, in this example, we can see where when price touched this psychological level here, it reversed. And after price touched this level, it reversed. And we can also see other examples of reversals whenever price touches the psychological levels. So, in this example, you can see that price came up here, it reversed. Let's look at GBP USD. In this case, price used this psychological level as an area of support. So, as you all know, we buy from these areas. So, what you're looking to do as a trader is you're looking to sell from the red psychological levels and you're looking to buy from the green psychological levels, concluding with risk management and pragmatic advice for integrating psychological price levels into your trading strategy. Understanding these levels can substantially enhance your decision-making and risk control. Consider positioning your take-profit orders marginally beneath psychological price levels for long positions or above them for short positions. This tactic enhances the probability of your take-profit orders getting triggered. Likewise, akin to take-profit orders, you can calibrate your stop-loss orders to factor in psychological price levels. For long positions, position your stop-loss a tad lower than the psychological level, while for short positions, set it slightly higher. This safeguards you from getting prematurely stopped out due to sudden market fluctuations. Now, strategy works best during a consolidation. Now, a consolidation is when a price is not trending, it's merely bouncing from one level to the next. So think of it like ping pong. Price keeps bouncing between different areas of the market for an extended period of time. Trading like this is favorable to most Forex traders because, statistically speaking, the market is only trending 30% of the time. The rest of the time, the market is consolidating. It's in a range, so most of the time it's just bouncing up and down in a tight area. So that is why many traders prefer these types of trading strategies, because they're able to make a lot of profit when price is bouncing between different areas. And yes, even though you make more profit in a trending market because you get a lot more pips, if you consistently take a small pips back and forth, you'll be able to accumulate a lot of pips over time and a lot of profit. So click the link in the description below to get our psychological levels indicator. Remember to like this video and subscribe to our channel for more valuable insights. Happy trading!